Welcome back to the deep dive. I want you to picture a scene. It's 4:05 p.m. on a Thursday. The closing bell just rang on Wall Street. You're a trader, maybe you're just a retail investor, and you are glued to your screen.
Yeah.
You're holding a stock, you're nervous, earnings are about to drop.
It's that moment, right? The most stressful time of the
Oh,
quarter.
absolutely. And then, boom, the press release hits the wire, you scan the numbers, your eyes are flying across the screen. Revenue, it's a beat. Earnings per share, a massive beat. It's the holy grail, the double beat.
You're thinking, okay, here we go. This is it.
Exactly. You lean back in your chair, you're ready to watch your portfolio turn bright green. You're expecting champagne corks to fly.
A victory lap.
Yes. But then you look at the ticker, and it's not green. It is red. Deep, deep red. The stock doesn't just dip, it tanks. We're talking a drop of nearly 9% in extended trading. It feels like a punch in the gut. It's a paradox. It's confusing. And, frankly, it makes you wonder if the market is broken or if you're just missing something huge.
Well, it's a classic case where the headline numbers, the ones that, fit neatly in a tweet, they tell one story. But the institutional investors, the big money, they're reading a completely different book. They aren't just looking at the what. They're digging into the how and, more importantly, the what's next.
And that is the mystery we are solving today. We're unpacking the Q4 2025 earnings for Illumina, ticker symbol ILMN. They're the 800-pound gorilla of genomic sequencing.
Absolutely, the dominant player.
It's Friday, February 6th, 2026. The earnings dropped yesterday afternoon, and the dust is still settling. Our mission today is to figure out how a company with only 5% revenue growth managed to engineer this staggering 42% jump in earnings per share, and why, despite all that financial wizardry, Wall Street is just giving them the cold shoulder.
We're going to have to do some, serious detective work today. We've got to look past the shiny numbers in the press release.
Yeah.
We need to understand the difference between GAAP reality and non-GAAP reality.
Yeah.
We need to dissect a geopolitical split that is effectively tearing the business into two different hemispheres. And we need to answer the ultimate question for you, the listener. Is this a turnaround story, or is it a value trap?
Before we dive in, this analysis is brought to you by STOCKANALYTICS.AI. Get institutional-grade research on over 600 stocks for just $10 a month, plus request any ticker and download your own video analysis. Start your 7-day free trial at STOCKANALYTICS.AI. Now, let's get into it.
Let's get to work.
To keep us organized, because this report is, it's dense, we're going to structure this deep dive by walking through 5 distinct themes. Think of them as slides in a presentation we're giving to investment committee. So let's pull up the first one. Slide 1, the at-a-glance scorecard.
Okay, so this is where we establish the baseline. We just need to know what actually happened before we can start trying to interpret the market's mood.
Right, first things first. So I'm looking at the top line number. Total revenue for the fourth quarter of 2025. It came in at $1.16 billion. Now, I'm looking at my notes here for Q4 24, and they did $4 billion.
Right.
I'm just doing some quick napkin math here. That's about a 5% increase year over year.
That's correct. And if you want to be really precise about it, if you strip out the currency fluctuations, because the dollar's always moving around, it's about 4% growth on what they call a constant currency basis.
Okay, so 4 or 5%. I have to be honest with you, for a company that was once considered this high-growth tech darling, that feels a little underwhelming. Is that really something to celebrate?
Context is everything here. You have to remember where Illumina has been for the past year or so. Fiscal year 2025 was a slog for them. I mean, a real grind. For the full year, revenue was basically dead flat. It was $4.34 billion, almost identical to what they did in 2024. The company has been just stuck in the mud. So, seeing a 5% bump in Q4 isn't really about hyper growth or anything like that. It's a signal. It says, okay, the stagnation might be over. The bleeding is stopped. It's like, a pulse check.
Okay, so they have a pulse. That's good. Revenue is finally moving in the right direction. But here is where I get really confused. I'm looking at the bottom line now. Net income. And this is where things get weird.
There's that wild divergence we hinted at right at the top.
Yeah. So I'm looking at the GAAP net income. That's generally accepted accounting principles, the official by-the-book number. It came in at $334 million.
Wow.
That's a surge of 185.5% compared to the previous year. That looks incredible, but then right next to it, I see the non-GAAP net income is only $208 million.
Which is still up about 37%. A very respectable number.
But hold on a second. Usually when companies report non-GAAP or adjusted earnings, they're trying to make themselves look better. They strip out the bad stuff to show a higher number.
Right, they're adding back stock-based compensation restructuring charges.
Exactly. But here, the official GAAP number is $126 million higher than their adjusted number. It feels totally backward. What am I missing here?
It's a great catch, and it's exactly why you always, always have to read the footnotes. The culprit here is a little line item called Other Income. In Q4 2025, Illumina recorded a benefit of $176 million in this category.
Okay.
In the same quarter of the previous year, that line was only $13 million.
176 million. That's a massive chunk of change. Did they sell a building? Did they find a suitcase full of cash in the parking lot? What is that?
It's almost certainly investment gains. You have to remember, Illumina isn't just a manufacturing company. They also run a venture fund, Illumina Ventures. They hold stakes in other biotech startups, partners, companies like Helix. Under accounting rules, if the value of those private companies goes up, or if they cash one out, they have to record that gain on their income statement.
Okay, I get the accounting, but does an unrealized paper gain on a startup investment have anything to do with selling DNA sequencers to a hospital in Ohio?
No, zero. It has absolutely nothing to do with their core operations. It's what we call noise. It's a distraction.
So the GAAP number is kind of lying to us, or at least it's very misleading.
It's accurate accounting for sure, but it's poor logic if you're an investor trying to figure out the health of the business. That $334 million profit is inflated by this huge one-time sugar rush of investment gains.
Right.
And that is why, for our purposes today, and for any serious investor who is trying to model the future, we have to just ignore it. We have to look at that non-GAAP figure. That $208 million is the true measure of the business.
Okay, so we throw out the sugar rush. We focus on the $208 million. That is still up nearly 37% year over year.
Which is fantastic performance.
But wait a minute. I'm still stuck on the math. Revenue, the money coming in the front door, only grew 5%. But the profit, the money they actually got to keep, grew 37%. How on earth do you grow profit 7 times faster than your sales?
And this brings us right to the earnings per share, or EPS. This is where it gets even more pronounced.
Right. Let's look at that. The GAAP EPS was $2.16. Huge. But let's stick to the non-GAAP, the real number. Non-GAAP EPS came in at $1.35. And that's up 42.1% from 95 cents a year ago. A 42% jump.
And just keep that number in your head. A 42% earnings growth on only 5% sales growth.
It sounds like magic or, some kind of accounting trick.
It's not magic, it's mechanics. Specifically, there are 2 types of mechanics at play here. The first one is something called operating leverage.
Operating leverage. Okay, that's one of those MBA buzzwords. Before we apply it to Illumina, can you explain it like I'm 5? What does that actually look like in a real business?
Sure. Imagine you run a lemonade stand. It costs you $100 a day to rent the stand and, buy the juicer. That's a fixed cost. It doesn't matter if you sell 1 cup of lemonade or 1,000. You still pay that $100.
Okay, got it.
The lemons and the sugar are your variable costs. They cost you money for every single cup you sell.
Right.
Now, if you only sell 10 cups, that $100 fixed cost eats up all your profit. You're probably losing money. But if you sell 100 cups, that $100 rent is now spread out over a lot more sales. Suddenly, almost every extra dollar you make from selling another cup goes straight to your pocket because the rent is already paid. That's operating leverage.
So you're saying Illumina has really high fixed costs?
Massive. Think about it. R&D labs, huge factories, a global sales force, corporate headquarters. But here's the genius of what they did this quarter. They actually cut those costs.
While growing revenue?
While growing revenue. Look at the numbers. Revenue grew by $55 million year over year. But if you look at their non-GAAP operating profit, it grew by $57 million.
Wait, hold on. They grew their profit by more dollars than they grew their revenue. How is that possible?
Because they spent less money to run the company this year than they did last year. Specifically, if you look at their R&D expenses, they actually decreased from $256 million down to $239 million.
So they're tightening the belt. Big time.
Aggressively. They are extracting more profit from every single dollar of sales. So that's driver number 1. Driver number 2 is a bit more financial. It's financial engineering specifically. Share buybacks.
Ah, buybacks. I always hear about these. Why do companies do this? What's the point?
Okay, so think of the company's total earnings as a big pizza. The shareholders are all the people waiting to eat that pizza. If you cut the pizza into 160 slices, everyone at the table gets a certain amount of cheese and pepperoni. That's your earnings per share.
Okay, that makes sense.
Now imagine the company takes its own cash, walks around the table, buys 6 slices back from people, and then just throws them in the trash.
That seems kind of wasteful, doesn't it?
Well, now there are only 154 slices of pizza remaining. But the pizza itself is the exact same size. So the people who are still at the table, their remaining slices just got bigger.
Ah.
Illumina reduced their diluted share count from 160 million down to 154 million. That is a drop of 3.8%.
So they bought back their own stock, they retired those shares, and poof, the EPS number looks almost 4% better just because of division?
Correct. It's just math.
Hmm.
So when you combine serious cost cutting, that's getting the operating leverage, with a nearly 4% reduction in the share count, that's how you bridge that massive gap. That's how you turn 5% revenue growth into 42% earnings growth.
That's a masterclass in management efficiency. But I can also see why the market might be a little bit wary of that. You can't cut costs forever, right? You can't just starve yourself to prosperity.
Right.
And you can't buy back stock forever. Eventually, you need to actually sell more lemonade.
Precisely. And that is the anxiety that's hanging over this stock right now. Efficiency has its limits. Real sales growth doesn't. But, before we get too critical, we have to admit their profitability engine is just humming. Which brings us to our next slide.
Slide 2, the engine of profitability.
Yeah, this is where we really look under the hood. We're talking about margins. Margins tell you if a company has real pricing power or if they're just, desperate to make a sale.
Okay, so let's start with gross margin. This is basically revenue minus the cost of making the actual thing they sell. Their non-GAAP gross margin rose to 67.4%, up a little bit from 67% last year.
That is a very, very healthy number. A 67% gross margin is really strong. It puts them in the same tier as high-quality software or tech companies.
But why is it so high? They make hardware. They make these big, complex machines. Usually hardware margins are much lower, like, 30 or 40%.
But see, that's the trick. They aren't just a hardware company. They operate on the classic razor and razor blade model.
Okay, break that down for us. I think I know what you mean, but spell it out.
So the razor is the sequencer itself, the machine. These are expensive, very complex boxes. They can cost anywhere from $20,000 for a small one to over $1 million for their high-end Novasec X.
Wow.
They make some margin on those machines, but not a ton. It's not where the real money is.
Okay, so where is it?
The razor blade is the consumable. The flow cells, the reagents, the proprietary chemical kits. You absolutely cannot run a sequencing experiment without buying a brand new kit from Illumina for every single run.
Ah.
And you can't just use, generic soap. You have to use their specific proprietary chemistry that only works with their machine.
So once a hospital or a lab buys the machine, they're completely hooked.
They're locked in. The switching costs are astronomical. And that chemistry, that's essentially, high-tech colored water in a little plastic cartridge. The markup on that is massive. That is what drives that 67% margin. And the fact that it ticked up even slightly in this environment, it shows they have real pricing power. They aren't facing some crisis where they have to slash prices just to keep their customers.
That's a fantastic moat. If I'm a hospital, I can't just switch to a competitor's machine easily. I've already invested $1 million in the Illumina box.
Exactly. The investment is huge. Now, let's look even further down the income statement at the operating margin. This is what's left after you pay for the lights, the sales team, and all that R&D we talked about.
The non-GAAP operating margin jumped to 23.7%, and that's up from 19.7% the prior year.
That, right there, is the star metric of this entire report. That is a 400 basis point expansion.
4% doesn't sound like a lot in a regular conversation, but in finance, a 400 basis point move is huge, isn't it?
It is absolutely massive. It validates that whole disciplined execution narrative the CEO is pushing. It means they aren't just growing for the sake of growing. They are transitioning to early profitable growth. They are just running a much, much tighter ship.
I do want to go back to something weird I saw in the tax section, though. We saw that GAAP tax rate just plummet.
Oh, yeah. This is what we sometimes call the tax holiday effect, though it's usually more complicated than that.
It dropped to 11.6% from nearly 38% the year before. I mean, that sounds great for them, but it's Probably bad for our analysis, right?
It creates a huge distortion. Corporate tax rates fluctuate all the time based on where they make the money geographically,
Hmm.
research credits, one-off legal settlements. That super low tax rate gave a one-time artificial boost to the GAAP earnings.
Right.
It's like finding a 50% off coupon at the checkout counter. It's nice today, but you can't build your family's budget assuming you're going to find that coupon every single week.
So we should pretty much just ignore the 11.6%.
Yes. For forecasting purposes, you have to. Stick to the non-GAAP tax rate, which held pretty steady at around 19.5%. That's the sustainable reality. That's the number you can build a model on.
Okay, so pulling this all together for slide 2, what we have is a company that is stripping out all the noise from investments and taxes to show us a core business that is getting significantly more profitable. The machine is just incredibly efficient.
The machine is very efficient. But, efficiency is only half the battle. You need growth. You need to know where the sales are coming from. And, maybe more importantly, where they are vanishing.
And that brings us to what I think is the most dramatic part of this entire report. Slide 3, the engine room business segment performance.
This is so critical. If you own Illumina stock today, you are effectively owning two completely different companies right now.
We have the world and we have China.
And they are moving in polar opposite directions. It's a tale of two businesses.
Let's start with the good news then, the ex-China performance. So this is the Americas, Europe, Asia Pacific, basically everywhere except for mainland China.
This segment, the core of the company, brought in $1.1 billion in revenue for the quarter, and it grew 8% year over year.
8% growth, and this represents, what, 95% of the entire company now?
Correct, and that right there is the key takeaway. 95% of the business is healthy, and 8% growth rate for a mature, large-cap company like Illumina is solid. It's really good, and it validates this narrative of clinical momentum that management keeps talking about.
Okay, let's unpack that term a little bit. Clinical momentum. What does that actually mean? Who is the customer here?
So historically, Illumina sold mainly to researchers. Universities, government labs like the NIH. That business is cyclical. It depends heavily on grants and government funding, which can be unpredictable.
Right.
Clinical means hospitals and diagnostic labs. It means using sequencing for actual patient care right now.
So things like cancer testing.
Exactly. Oncology is the huge one. Testing a patient's tumor to see what specific genetic mutation it has so you can pick the exact right drug for them. Or NIPT, non-invasive prenatal testing. Taking a simple blood sample from a pregnant mother to screen the fetus for genetic conditions like Down syndrome.
So these aren't just like science experiments anymore. These are becoming medical necessities.
Correct. And that demand is sticky. A hospital doesn't stop testing cancer patients just because the economy is a little slow. That 8% growth tells us that the transition from Illumina being just a research tool to becoming the standard of care is really happening.
Okay, so the West is buying. Hospitals are on board. But then there's China.
Then there is China, the elephant in the room.
Now, I was looking through the press release and the filings, and they don't explicitly put a big, red, bold number in there saying China revenue. We had to do some detective work here to figure this out.
We did, yeah.
Yeah.
But it's pretty simple subtraction, really. If the total revenue for the quarter was $1.159 billion, and we know that ex-China was $1.100 billion.
That leaves about $59 million for China.
About $59 million. And last year?
Last year, doing that same math, it was roughly $80 million.
Right.
So $80 million down to $59 million, that is wow.
That is an implied decline of about 26%.
Ouch. A quarter of their business in China just evaporated in a single year. What on earth is happening? I know there's geopolitical tension, but the report says that the Ministry of Commerce, MOF.com, actually lifted an export ban. Shouldn't things be getting better, not worse?
It's incredibly complicated. Yes, the official ban was lifted, but Illumina is still on what's called the unreliable entities list.
That sounds like a list you definitely do not want to be on.
It's a scarlet letter in the Chinese market. It's a geopolitical designation by Beijing. And what it means is that even though they can technically sell their products, every single sale is scrutinized. It requires special approvals. It adds layers and layers of friction and delay.
But why? Why is China targeting a gene sequencing company? It's not like they're making fighter jets or advanced semiconductors.
But in the 21st century, genetic data is a national strategic asset. There is a massive global fear around biosecurity. Governments are terrified of foreign powers having the genetic data of their population. The U.S. worries about China having ours, and China worries about the U.S. having theirs.
So Illumina is basically caught in the crossfire of a new bio-Cold War.
That's a perfect way to put it. Plus, China has a domestic champion they're trying to build up.
Yeah.
BGI, the Beijing Genomics Institute.
Yeah.
The Chinese government wants its hospitals to buy BGI machines, not Illumina machines. So between the regulatory friction and this huge buy local push, Illumina is just getting squeezed out from both sides.
So for the listener, the takeaway here is pretty stark then. When you buy Illumina stock right now, you are buying a growing, healthy, global business that is being dragged down by this shrinking Chinese subsidiary.
Exactly. It's a hole in the boat. But because the boat is so big, remember, China is now only 5% of total revenue, and the hole is getting relatively smaller as the rest of the boat grows. The ship is still moving forward. But you have to go into it accepting that China might go to zero eventually.
Let's shift gears back to the science for a minute. We talked about the razor and blade model, but they also just made a massive acquisition, SomaLogic.
Yes, this is their big strategic pivot for the future.
What does SomaLogic actually do?
They do proteomics.
Proteomics. Okay, I barely passed high school biology. You have to break that down for me.
So think of the central dogma of biology. It goes DNA to RNA to protein.
Okay, I think I remember that.
DNA is the blueprint. It's the architect's drawing. It doesn't actually do anything. It just sits in the nucleus of your cells and it holds information.
Got it. DNA is the library.
Perfect analogy. RNA is the messenger that goes into the library, makes a copy of a page, and carries the instructions out to the construction site. But proteins are the workers. They're the bricks, the mortar, the enzymes, the antibodies. They are what actually build your body and fight disease.
So if you want to cure a disease, you're usually targeting the protein, not the DNA blueprint itself.
Exactly. Almost all modern drugs bind to proteins to have an effect. And here's the key difference. Your DNA is static. Your DNA is the same when you're born and when you die. But your proteins, they change every single minute based on what you ate for lunch, if you're sick or if you're stressed out.
So proteomics is like a real-time snapshot of your health, not just the permanent blueprint.
Precisely. By acquiring SomaLogic, Illumina is moving from just reading the static blueprint, which is genomics, to analyzing the dynamic construction site, which is proteomics. The buzzword for this is multiomics.
That sounds like a buzzword, but I actually get the logic. Big pharma companies like AstraZeneca or Eli Lilly, they want the whole picture. They want to know, does this person have the gene for a disease? And are they actually producing the bad protein right now?
Correct. It positions Illumina to be the one-stop shop for all biological data. It's a very long-term play. It doesn't add much revenue yet, but it expands their total addressable market massively.
Okay, so the strategy seems sound. But these big acquisitions are expensive. Can they actually afford all this? Slide 4. Financial strength and shareholder rewards.
This is what I like to call the sleep well at night slide.
I like the sound of that. In a volatile market like this, cash is king. So let's look at the balance sheet.
It is an absolute fortress. We're looking at total liquidity. That's cash, cash equivalents, and short-term investments of $1.633 billion.
And how does that compare to where they were a year ago?
It's up over $400 million. They entered the year with about $1.22 billion. Now they're sitting on over $1.6 billion in cash and liquid assets.
That is a lot of cash to pile up in just 1 year. What about the other side of the ledger? What about debt? Are they drowning in loans to pay for that big SomaLogic deal?
Not at all. Their total debt is roughly $1.99 billion. But the crucial number for investors is net debt, which is just their total debt minus all that cash they have.
Right.
Their net debt is only about $356 million.
Yeah.
For a company with a market cap of over $20 billion, that is basically a rounding error. It's nothing.
And I'm seeing their current ratio here is 2.07x.
Which is just a fancy way of saying they have more than double the liquid assets they need to pay off all of their short-term bills. They could pay every bill twice over.
So solvency is not an issue. They don't need to go begging to the banks for money at these high interest rates.
No, not at all. They are completely self-funding. Which brings us to the cash flow statement. This, to me, is the truth serum. You can fake net income with accounting tricks, but you cannot fake cash in the bank.
Their operating cash flow for the full fiscal year was $1.1 billion.
$1 billion in cash generated just from their day-to-day operations. That's the engine. And here's the part I love. Their free cash flow was $931 million.
Okay, explain the difference for the listeners. What's the distinction between free cash flow and operating cash flow?
Operating cash flow is all the cash that comes in from selling to customers. Free cash flow is what's left over after you pay to maintain your factories and equipment, what's called capital expenditures, or CapEx.
So they converted almost 85% of their operating cash directly into free cash that they can do whatever they want with.
Yes. And that conversion rate is absolutely stellar. It tells you that this is what's known as a capital-light business.
Capital light. That seems a little counterintuitive. Don't they build these massive, complex, expensive machines?
They do, but they aren't like Ford or General Motors. They don't need acres and acres of blast furnaces and heavy machinery. Their manufacturing is more about precision assembly and chemical mixing. It doesn't require these massive, continuous investments just to keep the lights on.
So they generate a ton of cash, and they don't need to spend it all on new buildings or factories. So, the billion-dollar question. What did they do with that $931 million in free cash?
They gave it back to you. Well, indirectly at least.
The buybacks.
The buybacks. We talked about this back in slide 1. They reduced the share count by 6 million shares. That is where all that cash went. They used that $931 million in free cash flow to just soak up shares from the open market.
It really connects all the dots, doesn't it? The operational efficiency leads to higher margins, which leads to massive cash flow. The cash flow funds the buybacks, and the buybacks boost the EPS. It's a virtuous cycle.
It is, and it's a way of rewarding shareholders even when that top-line revenue growth is modest.
Yeah.
It's a way of, manufacturing returns when the market itself is slow.
Okay, so we've established they're a profitable, cash-generating machine with a fortress balance sheet, but I keep coming back to the intro. The stock dropped 9%. We still haven't fully answered why. If everything under the hood is so great, why did everyone sell the stock?
And that answer, my friend, lies not in the past, but in the future.
Slide 5. The road ahead management's outlook and key takeaways.
This is the moment of truth. This is the guidance. This is what all the Wall Street algorithms react to in a fraction of a second.
First, let's just touch on the vibe. The CEO, Jacob Thaysen, what's he saying in the press release and on the call?
He's projecting a lot of confidence. He's using phrases like disciplined execution and moving from stabilization to acceleration. He's basically trying to declare victory on the turnaround. He's saying, look, we stopped the bleeding, we fixed the margins, and now we're ready to build.
But the numbers he gave for 2026, they didn't quite dazzle the market, did they?
No, they landed with a thud.
Yeah.
Let's look at the revenue outlook for the full year 2026. They're guiding for $4.5 to $4.6 billion.
Okay, which translates to a growth rate of about 4% to 6%.
Correct, but there's a catch.
Of course, there's always a catch.
Remember the SomaLogic acquisition? That adds new revenue that wasn't there last year. It contributes about 1.5% to 2% to that total growth rate.
So if you strip out the acquisition, what is the organic growth? The growth of the actual core Illumina business?
It's only 2.5% to 4%.
2.5%. That's barely above inflation. That's the kind of growth you expect from a utility company.
Exactly. And that is the entire problem right there.
Yeah.
Illumina still trades at a high valuation multiple because for years, people have thought of it as a high-growth biotech stock.
Right.
But 2% organic growth, that is a splash of ice-cold water in the face. Investors were hoping for a return to double digits, or at least high single digits. This guidance says we are growing, but we are jogging, not sprinting.
And what about the margins? We just celebrated that fantastic 23.7% operating margin in Q4.
The guidance for 2026 is for 23.3 to 23.5%.
Yeah.
So margins are expected to be flat, or even slightly down from where they just were.
But why? I thought they were these efficiency masters now.
SomaLogic again. Integrating a whole new company costs a lot of money. You have redundant staff, different IT systems, you have to combine sales forces. They explicitly said the integration will be a drag on margins this year. Plus, there's an 18-cent dilution hit to EPS from the deal.
So the big strategic acquisition is good for the long-term story, that whole multi-omics dream, but it actually hurts the numbers in 2026.
Exactly. It is the classic definition of short-term pain for long-term gain. But Wall Street is notoriously impatient. They hate short-term pain. They see the drag on earnings and the slow organic growth, and they just hit the sell button.
So let's wrap this all up with some key takeaways for the listener who might be staring at their portfolio right now, trying to decide what to do with this stock.
Takeaway number 1, the turnaround is real, but it is slow. They went from 0 growth to about 5%. The ship has turned around, it's not sinking anymore, but it's not a speedboat yet. You have to have patience.
Takeaway number 2.
Profitability over growth. This is the new DNA of this company. When you see earnings growing 8 times faster than revenue, that tells you everything you need to know about management's priorities. They are obsessed with efficiency and cash flow now. They are not chasing growth at all costs anymore.
Which is probably a much safer strategy in this kind of economy, to be honest. It puts a floor under the stock.
It does. It removes the risk of them running out of money or having to do a desperate capital raise.
Takeaway number 3.
The China drag. You have to mentally separate China from the rest of the business. China's a negative 26% hole in the boat. The ex-China business is growing at a healthy 8%. So if you believe the China situation will eventually stabilize or just become so small it doesn't even matter, then the core business looked pretty darn good.
And finally,
The strategic shift. They are betting the farm on multiomics. Buying SomaLogic is a clear signal that they want to own the entire biological beta stack, not just the DNA piece. It hurts the earnings number now, but it's the only way for them to significantly expand their total addressable market in the next decade.
so what's the final verdict here?
Illumina is a show-me stock right now. Investors are in wait-and-see mode. They're waiting for the company to shift into second gear. Can that clinical momentum plus this new proteomic stuff actually push growth back above 10%? Until that happens, it's a fortress balance sheet company that's printing cash, but it's growing slowly.
You know, it's interesting. I want to leave the listener with a final provocative thought here. We usually think of Illumina as this high-flying growth stock. It's biotech. It's the future of medicine.
Right.
But when you look at this report, 2% organic growth, massive cash generation, aggressive buybacks, a laser focus on margins, has Illumina effectively transitioned into a mature value stock?
That is the big debate right now on the street. Has it fundamentally changed its stripes?
Because if it's a value stock, it might actually be cheap right now after that drop. But if you're buying it today, expecting it to double in 6 months, like some kind of tech startup, you are definitely looking at the wrong ticker.
A very different mindset is required to own it today versus 5 years ago. And maybe that's the adjustment period we're seeing in the stock price right now. The investor base is rotating from the growth chasers to the value hunters.
A fascinating deep dive. It's never just about the headline number, folks. It is always about how you get there. Want institutional-grade stock research without the institutional price tag? Check out STOCKANALYTICS.AI. For just $10 a month, you get full access to our deep dive video library covering over 600 S&P 500 and NASDAQ 100 stocks, each with full source citations you can verify. Can't find the stock you're looking for? Request analysis on ANY ticker and download your own video within 24 hours. Upgrade to Pro for $20 a month and unlock our SEC Risk Scanner, which detects red flags in company filings before they hit the headlines, plus our Portfolio Diversification Analyzer to optimize your holdings. Start your 7-day free trial today at StockAnalytics.AI. Make smarter investment decisions with research you can trust. And just a reminder, nothing we said today constitutes financial advice. We are AI-generated avatars discussing publicly available data, so please do your own research before making any investment decisions.
We'll see you on the next deep dive.
Thanks for listening.